In this video, I want to make a serious prediction about the US stock market. I think the S&P 500 is at a risk of a major correction. At current levels of around 7,400, I think it could fall to at least 5,700. That would be a decline of roughly 22 to 23%, and more specifically, this correction will come through AI. Now, I want to be very clear from the start. This may not happen. I could be wrong. The market could keep going higher before it falls. I also want to say that I'm not invested in the US stock market and I do not plan to be. This is not a financial advice, but I will discuss some things that you can use from my analysis. The strongest argument against my view is the one made by Gary Stevenson. His argument essentially is that as inequality rises, more and more wealth gets concentrated at the top. Rich people and large institutions then need to put somewhere that money. And one of the obvious places they put it is in the stock market. So even if the real economy is weak, the asset prices keep rising because the wealthy keep buying financial assets. And I think that's a strong argument. The S&P 500 may continue to rise in the short term, and I'll come back to the timing later in the video. But the argument depends on a big assumption. It assumes that the stock market can keep rising mainly because rich and the institution keep buying assets. It assumes that the ordinary people, workers, and poor consumers do not matter at all in the stock market. And this is, I think, a big assumption where I disagree. The stock market is not just a scoreboard for the rich investors. Behind every stock price is a company. Behind every company are employees and customers and expectations about future growth. Rich investors can push prices higher, but they cannot by themselves create unlimited real demand. At some point, companies need customers need income, and income depends on jobs, wages, and purchasing power. So the same inequality that pushes money into the stock market can also weaken the real economy underneath it. And I think this risk will show up most clearly through AI. My prediction has three reasons. And the first reason is what I call the difference between productivity and efficiency, the productivity efficiency gap. Now, the bullish argument for AI is that since this is a general purpose technology or GPT, that it will affect every sector and it will help discover new medicines, build new products, innovate faster. And if that happens, yes, the economy becomes more productive, companies become more profitable, and the stock market continues to rise. I understand this argument, but I think the market is moving too quickly from one claim to another. The first claim is that AI can improve productivity, and the second claim is that AI has already justified today's valuations. Those two are not the same things. Real productivity is hard. It means creating new value, new products, new discoveries, new medicines. And efficiency is something which is completely different. Efficiency means doing the same work with fewer people, lower costs, and more pressure on the existing workers. And this is what I'm seeing right now. There is more evidence of efficiency rather than productivity. Take science, for example. AI can help produce papers, code, experiments, ideas, and solutions. But those outputs still need to be checked, reviewed, and recognized by human peer reviewers. Now, they need to judge whether the work is actually valuable. In some cases, AI, therefore, does not reduce the bottleneck. It, in fact, crowds the bottleneck. Journals are flooded with AI-assisted papers, low-quality submissions, or what people now call AI slop, then more output does not automatically mean more progress. The same applies outside science. AI can generate code, marketing, copy, more legal drafts, but someone still has to check the work. Someone has to take responsibility. Someone has to decide whether the output is correct and useful. So the question is not whether AI can produce more stuff. Yes, it can. The question is whether that extra output becomes valuable productivity or just simple noise. Right now, what companies can do much faster is not deep innovation. What they can do much faster is cost cutting. This is where the efficiency argument becomes important. Companies can ask whether they can do the same work with fewer people. Can we write the same software with fewer coders? Can we slow hiring because existing workers can now use AI tools? That is not productivity, that is efficiency. And efficiency can look good for one company in the short term. You have lower costs, fewer workers, and higher margins. That can all please the investors, but if companies do this at the same time, it creates a bigger economic problem because workers are also consumers. So if companies slow hiring, cut jobs, reduce wages, or increase the pressure on workers, then the broader economy is actually losing in the long term. This brings us to the contradiction in the market. What looks good for one company can be dangerous for the whole economy. At the individual level, many workers may say that AI is making them more productive, and that may be true, but the company level, expectations are adjusting. If one worker can do twice as much with AI now, the company is saying, great, now your new target is twice as high. So workers end up running faster on the treadmill just to stay in the same place. Output goes up, but security does not. Workload goes up, but bargaining power actually goes down. This is why I think market is confusing efficiency with productivity. AI may eventually create deep productivity gains, but that process takes time. But what companies is doing right now is to reduce cost. And companies are slowing the hiring, they are starting layoffs. Many CEOs are signaling to the market that they are taking AI seriously by actually showing the number of tech layoffs. And this year it is so far at more than 114,000 according to a layoffs tracker. This is already approaching the level of layoffs from the last year, and we are not even at the halfway mark. Now, this may support earnings in the short run, but it does not prove that AI is creating broad-based prosperity. Now, the second reason I'm worried is the valuation of tech companies itself. The S&P 500, for example, in practice is heavily influenced by a small number of very large tech companies. The share of S&P 500 market cap held by the top 10 tech companies is almost 40%. The point is, S&P 500 is no longer just a broad bet on the American economy. Increasingly, it is a bet on the AI growth story. That creates a concentration risk. If a small number of AI-linked companies keep rising, the index looks strong. But if those same companies disappoint, the whole index can fall. This is important because AI is not just a technology story anymore, it's become a valuation story. Investors are not only betting that AI will be useful, they are betting that AI will be so profitable, so widely adopted, and so defensible that it justifies these enormous market valuations. But the AI boom has one major problem. It's extremely expensive right now. AI companies and big tech firms are spending enormous amounts of money on chips and data centers and computing capacity. US tech giants were collectively planning to spend about $750 billion this year alone on AI infrastructure. And the more advanced the product becomes, the more expensive it becomes to run. Text generation is expensive, although they argue it's getting cheaper, but image generation is more expensive and video generation is much more expensive. The question then is whether people will pay enough for AI to justify the cost of building and running it. Usage is not the same as profitability. Adoption is not the same as margins. Hype is not the same as earnings. Right now, many AI companies appear to be subsidizing usage to just gain customers and engagement. For instance, OpenAI and Disney had announced a 3-year deal. Disney also announced that it will invest $1 billion in OpenAI, but OpenAI actually killed its video model called Sora because it was melting their servers without generating the expected revenue. So the broad point is a product can be impressive, it was a good product, and still be unprofitable. A product can have millions of users and still have weak unit economics. A company can grow quickly and still fail to justify its valuation. This is why investors, I think, are becoming nervous whenever a cheaper model appears to achieve similar capabilities, for example, DeepSeek from China. That reaction tells us investors are also afraid that the economics may not be as strong as the AI firms promised. If similar performance can be achieved with cheaper models or open source alternatives, then the valuations become less certain. At the same time, the companies making these huge AI investments are also using AI to cut costs, slow hiring, and increase efficiency. So on one side, they are telling investors that AI will create this massive new growth. On the other side, they're using AI to reduce labor costs. That brings us back to the first point. If AI mainly works by reducing jobs, slowing hiring, and weakening wage growth, then where does the final demand come from? Who pays for all this AI? Who pays enough to justify the data center? That is the contradiction. AI may make individual companies more efficient, but if it weakens consumer demand across the economy, then the market has a problem. And because AI valuations are concentrated in just a few giant firms, that problem does not stay small, it pulls the entire S&P 500 down. The third point is the timing. I don't think market has to fall immediately. In fact, the S&P 500 may continue to rise for some time, and there are several reasons for that. First, like I said, Gary Stevenson's argument still matters, wealth is still concentrated, institutions still have money to deploy. Rich investors still need to buy assets. Second, AI companies and big tech firms have strong incentives to keep this AI story alive. The stronger the AI narrative, the easier it is to raise capital from the markets, attract investors. And third, which is the most important one, there are still major IPOs coming. SpaceX IPO is coming and it is positioning itself as an AI first. OpenAI and Anthropic IPOs are expected later in this year. Then the hype cycle should continue until those events are complete. A strategic move would be to shift some of their risks from private markets to public markets while sentiment is still strong. So I would not be surprised if the AI narrative remains powerful until some of these exits, these IPOs happen. That does not mean that the market is healthy. It means that the incentives are aligned to keep the AI story going. The trigger for the correction could be anything. It could be investors realizing that the promise of AI was overclaimed. It could be a cheaper model. It could be a geopolitical event such as the Iran war or an expected attack on Cuba. It could be the US midterm elections. It could be something else entirely. Usually when markets are this expensive, The trigger only becomes obvious in hindsight. But my view is that most likely this timing is after the major AI related IPO cycle has played out. So what can you do with this? Again, I want to be clear, I have no skin in the game. I'm not shorting the market. I'm not invested in the US market. I'm not telling you to panic, sell everything. If I knew exactly when the market was going to fall, I would not be sitting here making a YouTube video about it. I would be keeping that information to myself and I would be making a lot of money trading it. But I don't know the timing. Markets can stay irrational longer than people can stay solvent. My point is that you should understand the risk. If the market falls, you may choose to average in gradually. If you're planning to make a large new investment, I think it is worth asking whether you're buying into a hype cycle. At current levels, you may be paying for a very optimistic assumption about AI growth and profits. And if those assumptions disappoint, which I think they will, the correction could be a sharp one. So my prediction is that S&P 500 can fall to at least 5,700 and possibly lower. That does not mean it happens tomorrow. It does not mean there will be one clear trigger. And it does not mean that AI is useless. My argument is very specific, that the market is pricing AI as a productivity revolution. What we are seeing right now is mostly efficiency gains. The valuations are concentrated in a small number of companies. These companies are spending enormous amounts of money before profitability is fully proven. And the hype cycle may continue until major private investors have had a chance to exit through public markets. After that, the market may start asking the harder questions. Where are the profits? Where is the demand? Who's paying for all this computing? And the answers will be weaker than expected. In future videos, I will go deeper into why hype cycles like this happen. Thank you so much for joining me on Devilware's Data and giving me your attention.